Hey y'all, it is Saturday, February 28th. In this video, we're going to be talking about the latest news on AMC. I owe you guys a video giving you my quick summary thoughts about the Q4 earnings call that we listened to. Also this weekend, I'll be putting out some videos on IMAX and Marcus Corp, two other cinema chains that reported in the past week. Let's talk today though about some news with AMC regarding the debt restructuring and of course the company's earnings. And just to be clear before we get started, I don't own any AMC position right now. That's no secret. I've been telling you guys for 15 months now why I was not in the trade, because I look at cash flow analysis, box office, the amount of shares that the company has available, which was none most of last year. And so I'm waiting for the current corporate actions to complete, the equity offering that is ongoing right now, and then we'll see what happens. I've got the chart up on here. You can see where I exited my 2024 swing trade back in November because I told you guys there would be an offering coming up. That offering came a couple weeks later and the price got pushed down. Box office last year was not quite at the level we wanted to see it at for the industry, and so I told you again there would be another equity offering, another cash raise in Q1 of this year, because the company will burn cash a lot in Q1, the quarter we're in right now. And so that is why AMC is doing this $150 million equity offering, which is pushing the price down. It's not, in my opinion, hedge funds pushing the price down. AMC is selling shares, and Goldman, if there is a forward collar agreement, Goldman will be in their initial hedging period also selling shares. So all of you that are buying shares thinking you're screwing the shorts, AMC and Goldman Sachs, they say thank you. They do need people to buy those shares, but they are the ones putting the selling pressure on the stock. There will be some shorts participating as well, but most of the extra selling pressure right now is from AMC trying to raise money and Goldman Sachs lining up their hedge for the forward agreement. Short interest on the stock is sitting at about 27%. You'll notice the chart in the bottom far right. Around the day of the AMC vote where they authorized more shares, the short interest started climbing. And it is my belief that that is mostly due to the exchangeable note arbitrage. The lenders who are expecting to receive shares started shorting once they knew that they would get shares from AMC eventually, once the VWAP measurement period was over. And so I think that in coming months, we'll see likely the short interest go down once those convertible bondholders exchange their notes for shares. Then there's no reason for them to maintain a short hedge. So that is my prediction for the next several months. We're going to eventually see the short interest come down. In terms of recent press releases, we have this announcement from AMC, things we've known about for several weeks, that they wanted to renegotiate and push out the debt wall, the maturity date on some of the debt. That includes the $400 million of 2027 Odeon notes and about $2 billion of the term loan, which is due 2029. They're packaging that together and they want to restructure that. The idea is they push out the maturity and hopefully get a lower interest rate. And so they are shopping this debt right now. And that was the February 23rd press release that the company put out. And I was expecting, honestly, that they would drop a 8K by Tuesday or Wednesday, that debt had been sold. And here are the details and the interest rate that they were able to get. But we didn't get that 8K. So that tells me there is some friction in AMC selling all of the debt at a rate that they would like. And we'll find out when the official 8K drops. If you've been paying attention, we know that this particular new debt tranche, the S&P has assigned a B minus, I think, for this particular tranche of debt. Moody's, we got a report on Fridays assigning a B3. That would tell us that if AMC is successful in selling the debt, that they are hoping to get a rate between 9 and 10%. And I'm thinking, since they didn't get it sold and we didn't get an 8K within a couple days of the announcement on February 23rd, this press release from AMC, since we didn't get an immediate announcement, I'm kind of taking 9% off the table in my expectation, and I'd be happy to see 9.5%. If you're wondering how does that compare to the current rate that they're paying on the term loan for Q4, they were paying just over 10.7%. And on the Odeon 400 million of bonds, they were paying, I think, 12.75%. So even if they got 9.5, 9.75, even 10, that would be a reduction on rate on both of these debts that they're trying to restructure. Stay tuned next week and we'll see, hopefully, an updated 8K from AMC telling us that they successfully placed all of the debt. And here are the new rates. Once we know the rates, we can calculate if there is any favorable interest expense impact. Keep in mind as you're looking at headlines like this that when they talk about a B3 rating, it is not a re-rating for the entire company. AMC still has a junk rating for their credit rating, but this particular set of new debt, since it is senior secured debt, will be assigned a B3 rating from Moody's. And that is good. That's what we want to see because that is more than half the debt and they will get a lower rate. So stay tuned and let's see what happens next week. We're going to talk about the Q4 and 2025 earnings, but not in detail because we already covered it in a live stream and you guys probably are familiar with this stuff. I'm more interested in sharing with you guys my report card, the green, yellow, red dashboard that I use to analyze troubled companies or speculative trades to give you a picture of how I am looking at the risk in a trade. Now, many of you understand what high reward is. I think we all understand what high reward is. There is no discussion on social media about the other side of that equation, which is high risk. So I had a report card that I used to use. It was very basic, something like this. And I have decided this past week that this is not providing enough level of information for myself or for you guys to properly analyze any speculative stock. And so I have now version 2.0 of the Tony DeNaro dashboard, and we have 1, 2, 3, 4, 5 categories on the left, profitability all the way down to valuation and other. I have very objective grading criteria. As you can see, starting with earnings per share, cash flow, cash runway, current ratio, quick ratio, net debt to EBITDA, interest coverage, ROA, revenue growth rate, EPS momentum, PE ratio, trailing and forward, EV to EBITDA, and then some somewhat subjective categories and others, dilution risk, the short interest, that is objective. There is data for that. CEO and management, subjective. That is my opinion. Insider trades, we can get that from the SEC, and if the company pays a dividend or not. And just so you know, all of these criteria will be applied the same way to every company that we analyze here on the channel. I have defined criteria here in the bottom that tells me if you go to FinViz or stockanalysis.com and look up these data points, depending on what they are, you will get a red, yellow, or green answer. And just to give you a preview of what how AMC compares to something like an IMAX, you can see I have AMC rated overall score 1 out of 10, extreme risk. Why is that? Because there is a lot of red and yellow here. And I say in the notes here, the score is based on a weighted fundamentals emphasizing balance sheet and cash flow for safety. This dashboard tells us what is the risk side of the equation. Like I said, everybody understands the reward side of the equation. This spreadsheet, this dashboard does not tell us if a current price is a fair price or a safe price. That is not the purpose of the dashboard. If you decide to buy or hold the stock, this kind of lets you know what the opposing side is looking at. Wall Street, analysts, anybody who's shorting the stock, why are they doing that? The more red you have here, the more likely it is that they are not scared to short the stock. Compare that to something like an IMAX, all the same criteria, all the same scoring, and almost everything here is green. And there is a score here of 7.75, low to moderate risk is my score. And that is mostly why am I not giving them a 9 or 10? Because at almost $43, it is getting to the point where it might be overvalued. So that is some analysis that you can do on your own. But if you're just thinking, is the trade that I'm about to take relatively safe, or is the company likely to need to raise cash and dilute? That's kind of what the point of this dashboard is. And we'll be using this for any company that is not a blue chip. You don't need to worry about a dashboard like this if the company has growing revenues, if the company has growing earnings, if the company has massive positive free cash flow on an annual basis. You probably don't need to worry about something like this. But I think it is useful, even though I know some of y'all aren't going to like to see this, it's useful to think about. And hopefully these things that I have on here spur you, if you haven't been looking at fundamentals or reasons why a stock might be under pressure. Hey, here's a whole handful of things to go learn about. And when you're wondering about why a company's stock price is not performing compared to other similar competitors in the same sector that are going up, again, institutions are going to buy stocks that are relatively safe, that have all green. They're typically going to avoid or short companies that are highly speculative, have a lot of distress. I think that things get better for AMC once we get past Q1. The box office, I think, in Q2 through Q4 will be very good. Q1, I've been telling you guys for some time, is going to be a struggle. I know we have some good movies right now, Scream 7, Hoppers, Project Hail Mary at the end of the month. I'm expecting Q1 to come in 1.5 to 1.6 billion, 1.7 if you want to be super optimistic, but that'd be kind of a Hail Mary to get 1.7. So with a 1.5 to 1.6, there will be a cash burn in Q1, which is why AMC is trying to raise $150 million right now. The good news is I think there possibly, maybe, might be a magic moment towards the end of Q1 where the ATM is done and people start getting excited about better box office for the rest of the year. That selling pressure from the equity offering goes away. And if AMC does not do any more dilutive actions, corporate actions, things that we're not expecting, maybe the stock is allowed to move back up for the rest of the year. I think that Q2 through Q4 will be relatively neutral, maybe even positive for free cash flow. We got to get through Q1, and I know I've been in your face talking about Q1 cash burn. It's because, guys, everyone else is telling you don't worry about it, but you must worry about it because that is what is driving the equity offering right now. That is what is driving the price down. And all of these people telling you don't worry about Q1, don't look over here, look at Q2. They are doing you a disservice, these people on social media telling you don't worry about Q1. And I'm going to continue to call out that sort of disingenuous head in the sand behavior because that will kill your portfolio. That will kill your gains. That will kill your chance, even having a chance at recovering. These people are telling you everything's going to be fine. You're buying, and the price is going down because AMC and Goldman are selling shares, and there's just not a lot of people buying the stock. And that drives the price down. I might go long again. I'd love to go long again, but I'm not going to watch my portfolio get whittled down on a daily basis due to corporate actions. I prefer to come in after the corporate action is done. If I see the all clear flag being waved, and if that day comes in the next 30, 60 days, I will, of course, let you know. Until then, I remain on the sidelines, watching the news, watching the 8Ks, and watching the chart, waiting for some update that the ATM offering is done at a minimum. Looking at the Q4 results, total revenues were $1.28 billion. That is down slightly from the same quarter a year ago. There was a net loss of $127 million compared to $135 million a year ago. Adjusted EBITDA was positive. I don't really care too much about adjusted EBITDA. It's interesting, but it is the interest expense that is killing us. So looking at adjusted EBITDA and patting ourselves on the back about that is avoiding talking about the real pain that the interest expense is causing. Net cash provided by operating activities in Q4 was $126 million. Free cash flow was positive as we expected for Q4. Very typical because Q4 is a big box office, and the bills aren't due until Q1. So that creates this effect of a positive free cash flow in Q4. But the piper must be paid, and it's going to be paid heavy. It's going to be a heavy penalty when all those bills from Q4 got to be paid in Q1, plus the fact that Q1 is a low box office quarter. Hence, Sean Goodman, the CFO, doing a cash flow analysis just like I do, with much more tools and much more data, and saying we need to raise some money in Q1 so that we don't run out of cash. And that is what is going on right now. There will be a cash burn in Q1. We'll find out about how much in May, and I can estimate it once we see what the final Q1 box office ends up at. But I'm thinking, 300 million cash burn in Q1 would not be out of line. Looking at full year summary for 2025, total revenues were 4.8 billion compared to 4.6 billion for the previous year. Net loss was 632 million. A lot of that was non-cash charges related to debt restructuring, so I'm not going to penalize AMC or harp on that. A non-cash charge, it makes the income statement look bad, but at least it wasn't burning of cash. Adjusted EBITDA for the year, 387 million. Again, I don't care too much about adjusted EBITDA. If the company's burning cash, if the interest expense exceeds the money they're bringing in, that is what I care about. So interesting data point, but I don't really care about adjusted EBITDA just yet. Net cash used for the year was $119 million, slightly more than 2x the net cash used for the year of 2024. Free cash flow, negative $365 million, much more cash burn than the previous year, which was at $296 million. And it is that Q1 2025 that hurt AMC so bad in terms of free cash flow. It didn't matter that Q2 through Q4 of last year were free cash flow positive when you add them up. Q1 is the killer, and that is why I've been warning you guys so you're prepared in advance so that you know what to look at. That Q1 this year, the free cash flow, cash burn, is going to be vital to pay attention to. It will have some impact on how the rest of this year looks. And Wall Street cares about annual free cash flow. Wall Street does not care about Q2 through Q4. Do not let these people on social media and YouTube reframe this as, guys, let's just look at Q2 to Q4 and don't think about Q1. Again, that is going to lead you to make some very bad mistakes if you're listening to the YouTubers pushing this message. That is not me being negative. That is not me being bearish. That is me being fair and balanced. Annualized free cash flow is what matters, just like annualized earnings per share, annualized net income. All of that matters on an annual basis. Later today or this weekend, I will have the same type of video coming out for IMAX and Marcus Corp. The Cinemark video is already out. And if you guys have any questions about this video, comments, as long as you can comment like an adult. Don't get blocked. Don't be a child. If you have sincere questions or comments, leave them for me down below. I'd love to hear from you guys. Thank you for watching, and I will see you on the next video.